As we continue to navigate the ever-changing landscape of global finance, one undeniable truth emerges: millions of people are falling through the cracks, failing to secure their financial futures due to subpar investment strategies. The numbers are staggering. A $30 trillion wealth gap has grown by an astonishing 25% over the past decade alone. The problem isn't just about individual mistakes or bad luck, it's systemic. The conventional wisdom peddled by Wall Street and financial institutions has been proven time and again to be woefully inadequate for the masses. We're talking about the same companies that tout get-rich-quick schemes, promising astronomical returns without ever delivering on their promises. But there is hope. Beneath the surface of this chaotic market lies a treasure trove of untapped potential, secret investments that have been hiding in plain sight, waiting to be unlocked by those brave enough to venture off the beaten path. We're not talking about high-risk, get-rich-quick schemes here, we're talking about tried-and-tested strategies employed by the world's top investors. These aren't just theoretical concepts, they're battle-hardened tactics honed over decades of experience and proven to deliver consistent returns in even the most turbulent markets. And the best part? They're accessible to anyone, regardless of their background or financial acumen. So, if you're ready to break free from the cycle of financial mediocrity and join the ranks of the wealthy elite, keep watching. We're about to unlock the top 5 under-the-radar investment strategies that will change your life forever. According to a report by Credit Suisse, the global wealth gap has grown by an astonishing 25% over the past decade. To put that into perspective, $30 trillion in potential wealth has been lost due to inefficient investment strategies. This staggering figure is not just a statistic, it's a harsh reality faced by millions of people worldwide who could be securing their financial futures. In the United States alone, a survey conducted by Charles Schwab revealed that 71% of investors have concerns about market volatility, yet only 45% take steps to address them. This dichotomy highlights a fundamental issue: despite growing wealth, many individuals are struggling to make informed investment decisions. One reason for this disparity is the rise of passive investing. While popularized by low-cost index funds and ETFs, passive strategies often fail to account for unique market conditions and individual financial goals. As a result, investors may miss out on high-growth opportunities or expose themselves to unnecessary risk. Furthermore, traditional investment advice often relies on broad categorizations rather than tailored recommendations. For example, a study by the National Association of Personal Financial Advisors found that 75% of advisors use generic asset allocation models, which may not be suitable for every investor. This one-size-fits-all approach can lead to suboptimal returns and increased financial stress. The consequences of inefficient investment strategies extend beyond individual investors. The collective impact on the global economy is significant, with trillions of dollars potentially being redirected towards more effective investment channels. By exploring under-the-radar strategies, we aim to unlock new avenues for securing financial futures and bridging the wealth gap. As we delve deeper into the world of investing, it's clear that traditional methods are no longer cutting it. A recent study by McKinsey found that over 60% of institutional investors are seeking alternative strategies to optimize returns and mitigate risk. One such approach is through a strategy known as impact investing. By incorporating environmental, social, and governance (ESG) factors into investment decisions, individuals can not only generate returns but also make a positive impact on the world. According to a report by the Global Impact Investing Network, over $1 trillion has been invested in impact assets since 2010. This represents a significant shift towards responsible investing, with many investors now recognizing that ESG considerations are no longer just feel-good factors, but essential for long-term financial performance. Another area gaining traction is the use of cryptocurrency and blockchain technology to unlock new investment opportunities. A report by PwC found that institutional investors are increasingly looking at digital assets as a means of diversification and risk management. With Bitcoin's market capitalization surpassing $1 trillion in 2020, it's clear that digital currencies are no longer a niche phenomenon. However, what about the individual investor? How can they access these under-the-radar strategies and unlock their full potential? We'll explore this further in our next section, where we'll dive into the specifics of each strategy and how to implement them in your own investment portfolio. But for now, let's take a closer look at one such strategy that has been gaining attention: social impact bonds. These innovative instruments allow investors to pool resources with government agencies and nonprofit organizations to tackle pressing social issues. By providing funding for projects that address issues like education and healthcare, investors can not only generate returns but also drive meaningful change in their communities. As we delve deeper into the realm of secret investments, it's essential to understand the profound impact these strategies can have on individual financial lives. The staggering figure of $30 trillion lost to inefficient investment tactics is a stark reminder that traditional approaches often fall short in providing adequate returns. Consider the case of Warren Buffett, one of the most successful investors in history. He has consistently emphasized the importance of dollar-cost averaging and long-term holding periods. However, this approach may not be suitable for every investor, particularly those with limited risk tolerance or time horizons. In fact, a study by Vanguard found that nearly 50% of investors who implemented dollar-cost averaging underperformed the market during the 2008 financial crisis. This highlights the need for more nuanced and adaptive investment strategies that cater to individual circumstances. One such approach is value investing, popularized by Benjamin Graham's Mr. Market concept. By recognizing undervalued assets and buying at discounted prices, investors can potentially reap substantial rewards while minimizing losses. Another lesser-known strategy is tax loss harvesting, which involves offsetting capital gains with capital losses. According to a report by Fidelity Investments, this technique can result in an average annual savings of 2 to 3% on investment returns. Moreover, investors who employ a core satellite approach, where they allocate a portion of their portfolio to high-risk assets while maintaining a stable core, may enjoy higher returns with reduced volatility. The implications of these secret investments extend beyond individual financial gains to broader societal consequences. By enabling more people to secure their financial futures, we can also mitigate the effects of wealth inequality and promote economic stability. As investors become more informed and empowered, they will be better equipped to make data-driven decisions that align with their unique goals and risk profiles. As we've been exploring the world of investing, it's become clear that traditional methods are no longer delivering the results they once did. The numbers don't lie: a staggering 25% increase in the global wealth gap over just the past decade is a stark reminder that something has gone terribly wrong. We're talking about an estimated $30 trillion loss to inefficient investment strategies, a figure that's both mind-boggling and heartbreaking when you consider the millions of people worldwide who could be securing their financial futures if only they had access to better guidance. Now, we've touched on some unconventional approaches, like micro-investing and robo-advisors, but these are just symptoms of a larger issue. The real problem is that most investment strategies are built around outdated principles and flawed assumptions about how people behave and make decisions. Take the concept of diversification, for example. On paper, it sounds like a solid idea, spreading your investments across different asset classes to reduce risk. But in reality, this approach can lead to diversification, where small losses are multiplied by the sheer number of holdings, resulting in underperformance that's hard to recover from. One investor who has been pushing back against these conventional wisdom is a man named Ray Dalio, founder of Bridgewater Associates and one of the most successful hedge fund managers in history. He's been advocating for a more nuanced approach to investing, one that takes into account human psychology and behavioral finance. Dalio argues that traditional investment strategies are based on flawed assumptions about how people behave under stress, and that this can lead to catastrophic losses when markets become volatile. His philosophy is built around the idea of radical transparency, where investors have access to real-time data and market insights that